Hi, my name is Anna Anderson, and I'm a student loan expert at the National Consumer Law Center. Did you know that you have many different options when it comes to repaying your federal student loans? This video covers the ins and outs of federal student loan repayment options. If you have a Parent Plus loan though, your options are different, and you should refer to our video on Parent Plus loans for more repayment information. Option 1, Standard Repayment Plan. If you do not pick your repayment plan after you leave school, the Department of Education will automatically place you in the Standard Repayment Plan. The Standard Plan is structured to pay off your loan using fixed payments. The payment term is between 5 and 10 years, depending on the amount you owe on the loan. For consolidated loans, a standard repayment plan can be up to 30 years. Option 2, Income-Driven Repayment Plans, also known as IDR. If you can't afford your monthly payments under a standard repayment plan, you should consider signing up for an income-driven repayment or IDR plan. An IDR plan calculates your monthly payments based on a percentage of your income and the size of your family. IDR plans can have monthly payments that can be as low as $0 for some low-income borrowers. Because your payments may not cover the interest and principal, you may not see your balance decrease as you make payments in an IDR plan. However, one of the biggest benefits of an IDR plan is that your loans are forgiven after a certain number of years, usually between 10 and 25 years of payments. This is true even if your IDR payment is $0 per month. The time it takes to have your loans forgiven depends on many factors, including which IDR plan you're enrolled in and what type of loans you have. There are multiple IDR plans, including Income Contingent Repayment, also known as ICR, Pay As You Earn, also known as PAY, Income-Based Repayment, also known as IBR, and Saving on a Valuable Education, also known as SAVE. Each plan has different eligibility requirements, monthly payment calculations, and repayment links before the remaining balance is canceled. Some plans are only available for specific loan types. For example, Income-Based Repayment is the only plan available for FFEL loans. If you work in public service, both the 10-year standard repayment plan and IDR plans count as qualifying payments toward public service loan forgiveness. There are also two other types of repayment plans borrowers can request: extended and graduated repayment. Payments in these plans do not count towards IDR forgiveness or public service loan forgiveness, and they are designed to have you pay off your loans. The graduated repayment plan has a longer repayment period than the standard plan, with bills that start smaller and get larger over time. The extended repayment plan has fixed payments, but a longer repayment period than a standard plan. Under these plans, you may pay more in interest than in a standard repayment plan. It's really important that you have a good repayment strategy so that you avoid defaulting on your federal student loans. Defaulting on your federal student loans can have serious consequences. The federal government can take your tax refund, garnish your wages, or take a portion of other federal benefits. It will also impact your credit. What to do if you can't afford even an IDR payment? IDR plans are usually the most affordable, as they are based on your income. However, if you can't afford even an IDR plan repayment, you should call your loan servicer to ask for a forbearance or deferment to temporarily stop payments so that your loans won't go into default. There are multiple kinds of forbearance and deferments for different types of situations. However, using this option can be expensive because in many cases, the loan still accrues interest while in deferment or forbearance, and you won't earn credit toward loan forgiveness. Forbearances are generally easier to get, but deferments can be better for some borrowers because interest does not accrue on subsidized loans. Even if you can pay off your loan, consider enrolling in an IDR plan as a safety net. The IDR plan provides you with a minimum of what you must pay each month, while earning credit toward loan forgiveness. You can always pay more if you want to pay off your loan sooner. If you're enrolled in a standard plan, you can switch to an IDR plan in the future if you have trouble affording your payments. You can also switch which IDR plan you're enrolled in if that is better for you. To learn more about income-driven repayment plans, which one may be best for you, and how to apply, visit studentaid.gov and studentloanborrowerassistance.org, linked below.